Employee versus owner draws, tax implications you're missing. Hey everyone, whether you're a bookkeeper working with small business clients or a business owner trying to figure out the right way to pay yourself, this video is going to save you from making some very expensive mistakes. I'm talking about employee wages versus owner draws and the tax implications that almost everyone gets wrong. This is one of those topics where doing it wrong can cost you thousands or even tens of thousands in unnecessary taxes or IRS penalties. We're going to break down exactly how you should be paying yourself based on your business structure, what the IRS expects, and the red flags that will trigger an audit. Let's dive in. Before we get into the details, let me tell you why this is critical for both bookkeepers and business owners. For business owners, the way you pay yourself affects how much you pay in self-employment taxes. We're talking about a potential 15.3% difference. It affects your IRS compliance, your retirement contributions, and what happens if you get audited. For bookkeepers, understanding this topic is part of your value proposition. If you can guide your clients to the right compensation strategy, you're not just recording transactions, you're saving them real money. That's what makes you indispensable. I've seen business owners take all their compensation as distributions to avoid payroll taxes, only to get hit with massive back tax bills. I've seen others overpay on taxes for years because nobody told them there was a better way. Let's make sure you're doing this right. The way you pay yourself depends entirely on your business structure. Here's the quick breakdown. Sole proprietorship and single member LLC. You are the business and the business is you. You are the same entity for tax purposes. You take owner draws, just transferring money from business to personal. You cannot be an employee of your own business. For a partnership or a multi-member LLC, partners take guaranteed payments or partner draws. Partners cannot be employees of the partnership. S corporation, this is a tax election, not a business structure. Here's where things get interesting. You must pay yourself a reasonable salary as an employee. Then you can take additional profits as distributions. C corporation, you're an employee who receives a salary and can also receive dividends. Most small businesses avoid this due to double taxation. The rules for each structure are different, and using the wrong method can cost you big time. Let's start with sole proprietors and single member LLCs, because this is where I see the most confusion. How you get paid. You take owner draws, simply transferring the money from your business account to your personal account. No payroll, no W-2, no withholding. The critical tax point? Here's what catches people off guard. You pay self-employment tax on all your business profits, not just what you take out. For example, your business makes $100,000 in profit and you only took out $60,000 in draws and left $40,000 in the business. How much do you pay self-employment tax on? The full $100,000. Self-employment tax is 15.3%. That's $15,300 on $100,000 plus your regular income tax. Common mistakes are thinking you don't owe taxes because you didn't take out much money. Wrong. You owe taxes on your profit, not your draws. Second, not making quarterly estimated tax payments. If you owe more than $1,000, you need to make quarterly payments or face penalties. Third, pay attention to this, not tracking your draws properly. Every draw needs to be recorded. It doesn't affect taxes, but it affects owner's equity, and you need accurate records. Now let's talk about S corporations, because this is where you can save serious money, but only if you do it correctly. If you're an S corp owner who actively works in the business, the IRS requires you to pay yourself a reasonable salary through payroll. This is not optional. You get a W-2, taxes are withheld, your company pays the employer portion on payroll taxes, just like any other employee. Then, any additional profits can be taken as distributions, which are not subject to self-employment tax. This is the huge advantage. The tax savings? Let me show you the numbers, because this is powerful. As a sole proprietor making $100,000 in profit, you're paying $15,300 in self-employment tax. As an S Corp, you pay yourself a reasonable salary of, say, $60,000. You and your company pay about $9,180 in payroll taxes on that salary. The remaining $40,000 you take as a distribution, no payroll taxes on that portion. You just saved $6,120 in taxes. That's real money. For higher earners, the savings are even bigger. The reasonable salary requirement? Here's what gets people into trouble. Your salary has to be reasonable. You can't pay yourself $20,000 and take out $80,000 in distributions just to dodge payroll taxes. The IRS looks at several factors. What would you pay someone else to do your job? What are similar businesses paying for similar roles? What's your experience level and time commitment? What are the business's profits? A common guideline is 60-40, roughly 60% in salary, 40% in distributions. But this isn't a hard rule. It depends on your specific situation and industry. Here are some critical points. You need to set up actual payroll. This isn't just writing a check. You need payroll software or a service, quarterly 941 form, annual 940 form, and year-end W-2s. This has to be done correctly. Don't try to DIY this unless you really know what you're doing. The cost of getting it wrong far exceeds the cost of hiring a professional. And here's something crucial. You can only take distributions if you have a profit. If your company doesn't have retained earnings or current year profit, those aren't distributions. They're loans to you, and they need to be treated as such. When does S Corp status make sense? If your business is making less than $60,000 in profit, an S Corp probably doesn't make sense. The tax savings won't outweigh the extra costs of payroll and compliance. If you're making $100,000 or more, definitely explore the S Corp election with your CPA. All right, now let's talk about the red flags that can put a target on your back for an IRS audit. Red flag number 1, S Corp owners with zero salary or unreasonably low salary relative to distributions. If you're taking $20,000 in salary and $200,000 in distributions, that's basically waving a red flag at the IRS. They have algorithms that catch this, and they will audit you. I've seen this happen multiple times. The IRS reclassifies your distributions as wages, then hits you with back payroll taxes, penalties, and interest. It's ugly and expensive. Red flag number 2 is taking distributions when the company has no profit or negative equity. This doesn't work, folks. Distributions have come from retained earnings or current year profit. If your equity is negative and you're taking distributions, you're doing it wrong. Number 3, paying yourself an unreasonably high salary relative to business profits. If your business makes $80,000 and you're paying yourself $150,000 in salary, something's off. The math doesn't work, and the IRS will notice. Red flag number 4, not maintaining proper corporate formalities. This is huge. If you're an S Corp, but you're treating your business account like a personal piggy bank, commingling funds, not keeping proper records, not documenting decisions, you're inviting an audit. Separate accounts, proper documentation, clean record keeping. Red flag number 5, inconsistent treatment from year to year. If you took a $70,000 salary last year, but only $30,000 this year with no explanation, that raises questions. If your salary fluctuates wildly, you better have documentation explaining why. Red flag number 6, paying family members unusually high or low wages. If you're paying your spouse or kids, the compensation needs to be reasonable for the actual work they're doing. Paying your 12-year-old $50,000 to manage social media isn't going to fly. The bottom line is the IRS knows the games people play. Don't play games. Do it right. Let me quickly cover partnerships and multi-member LLCs because the rules are important. Partners cannot be employees. You take guaranteed payments or partner draws, and you pay self-employment tax on your distributive share of partnership income. Here's the key thing. Your tax liability is based on your ownership percentage, not on how much money you actually took out. If you're a 50% partner and the business made $200,000, You're paying self-employment tax on $100,000, even if you only withdrew $50,000. Make sure partnerships are issuing K-1 forms to each partner by March 15th. If partners don't get their K-1s on time, they can't file their personal tax returns. This causes major problems. For partners, understand your partnership agreement. Know your ownership percentage, how profits are split, and how guaranteed payments work. Don't assume anything. Let me hit a few important tax implications that people often overlook. Retirement contributions. If you're a sole proprietor, your contribution limits are based on self-employment income. If you're an S-Corp owner, your 401 limits are based on your W-2 wages, not distributions. This matters if you want to make large retirement contributions. Social Security benefits. Your future Social Security benefits are based on your earnings record or your W-2 wages and self-employment income. S-Corp owners taking minimal salaries aren't building up Social Security benefits as much as they could be. This matters long-term. Health insurance deductions. For S-Corp owners, health insurance needs to be run through payroll correctly to be deductible. It goes in box 1 of your W-2, but isn't subject to payroll taxes. If you just pay it personally without running it through payroll, you lose the deduction. All right, let's talk about what you need to do right now. Step 1, evaluate your current situation. Look at your business structure and know how you're paying yourself. Is it correct? Are you in compliance? Step 2, run the numbers. If you're a sole proprietor making good money, calculate what your tax savings would be with an S-Corp status. Compare the savings to the additional costs. Step 3, talk to a qualified CPA. Every business is different. You need personalized advice based on your situation, your state, your industry, and your goals. Step 4, if you're making a change, do it right. File the proper forms, set up proper payroll, keep immaculate records. Half doing this is worse than not doing it at all. Review your situation annually. Your business changes, tax laws change, and your personal situation changes. What made sense 3 years ago might not make sense today. Document everything. If there's ever an audit, you need to show why you made the decisions you made. Here's the bottom line. How you pay yourself as a business owner isn't just an accounting question. It's a strategic tax planning question. And the difference between doing it right and doing it wrong can be tens of thousands of dollars over the lifetime of your business. Don't make these decisions based on what your friend's business does or what you read in a Facebook group. Get professional help. The investment will pay for itself many times over. If this video helped you, please give it a thumbs up and subscribe for more content on taxes, bookkeeping, and small business finances. Here's my challenge. This week, if you're a business owner, schedule a meeting with your CPA to evaluate your current compensation method is optimal. If you're a bookkeeper, review your clients' situations and identify anyone who might benefit from restructuring. Drop a comment below with your questions. I read every single one, and I'll do my best to point you in the right direction. Thanks for watching, and I'll see you in the next video.